Mistake number 1, delaying. 19 years ago, I was a young banker on Wall Street. I was making hundreds of thousands of dollars a year, and I knew I should be investing that money. But I had a great excuse. It was the big financial crisis.
Soaring gas prices, falling home prices, and rising unemployment.
Every other week, my employer, UBS, was in the press announcing layoffs.
Swiss bank UBS, hard hit by the U.S. subprime crisis, has reported a first-quarter loss of $11 billion and said it will slash 5,500 jobs, almost 7% of its workforce.
The stock market kept falling and falling. So I thought, let's just wait for things to calm down. My mentor David, an older banker, said, "Tom, you're an idiot. There's never a perfect time to start. Just go for it." But I didn't listen, and it was possibly the most expensive investment mistake I ever made. I could have invested in stocks when they were 50% down, and I did not. But I'm grateful that I learned this mistake early in my investing career. Now, for the past 10 years, I've been an investment trainer. And over this decade, every single week, I get the same question from my students. They say, "Right now, the market feels kind of scary. Should I maybe wait for things to calm down before I start?" The truth is, occasionally, waiting does save you from a crash, but those rare occasions are impossible to predict ahead of time. The vast majority of the time, if you delay investing, you lose out. And that is why the most reliable approach is to start now and keep investing even as the market goes up and down. To explain the second mistake, let me tell you about my good friend Alex. Today, he's a multi-millionaire. He's a top boss at a major Wall Street firm. But just like me, he grew up in a poor family in Eastern Europe. So when Alex got his first job at an elite investment bank in New York, he was thrilled. He was making more money in a single month than his parents made in a year. Now, Alex was more responsible than me. He saved most of his income and invested in the market. But because he was so grateful to this elite Wall Street bank that hired him, because he so loved the culture of the firm, he believed in the company's future, well, he put all his money in the company's stock. Then September 2008 came, and his employer, the top Wall Street bank, Lehman Brothers, went bankrupt. Alex lost all his savings, and that was devastating to watch. This is why you should never make mistake number 2, overconcentration. If you put all or most of your money in a single investment, you can get wiped out in a moment. Most experts would say more than 10% in a single investment is very dangerous. But the smartest investors actually have hundreds of different investments in their portfolio so that even if one runs into trouble, you barely even notice. To illustrate the third mistake, let's discuss a professional gambler from Australia nicknamed the Joker. In April 2023, a group organized by the Joker bought up virtually all the possible 25.8 million number combinations in an American lottery called the Texas Lotto. Because nobody had guessed all 6 numbers for the Texas Lotto correctly for 7 months in a row, there was a huge jackpot available. When the Joker's team won, they got a whopping $57.8 million, which gave them a profit of around $20 million after taxes. You see, normally, buying a lottery ticket is one of the worst financial decisions you can make. The chances of winning are tiny. But when there is a huge jackpot, buying all the tickets can practically guarantee that you will win. Now, in lotteries, this kind of situation is very rare. Otherwise, people would do it all the time. Most of the time, even if you buy all the tickets, you still lose money. But in stock investing, this is actually quite normal. Over the past 50 years, the global stock market has been unstoppable. It has earned an average profit of 9% per year. And that has been enough to grow $10,000 invested 50 years ago to $750,000 today. But what most people don't realize is that the average stock over this time was actually a loser. When picking individual stocks, your odds are much better than when buying individual lottery tickets. But even so, if you buy a few stocks, you are more likely to lose than to win. The stock market is very profitable overall, but most of that profit comes from just a few big winning stocks. And those winning stocks are incredibly hard to guess ahead of time. That is why the third investing mistake that I want to share is this: picking individual stocks. The odds are against you. It's simply a bad bet. Instead, do what the Joker did. Buy up the whole game. In stock investing, that's possible when you invest in ETFs and index funds. These are funds which buy a little bit of every single stock in the market. This way, you're guaranteed to have the winning stocks in your portfolio. ETFs and index funds get you the market average result, which over the long term will almost certainly be excellent. Next up, ETFs and index funds are fantastic, but they can really cost you if you make one big mistake. Now, for me, ETFs and index funds are personal. I was one of the first people to bring this kind of investment to my European country, to Latvia. Around 10 years ago, I became the CEO of a pension fund called Indexo. And when we launched ETFs and index funds in Latvia, we made a big splash. We were on TV, we were in all the press. A lot of clients switched from competitors to us. Now, around that time, the CEO of a competing fund invited me to lunch. I was young and naive. I thought, okay, let me be friendly. So I went to lunch with him. Looking back from today's perspective, I realized he was just trying to mess with me, to play a mind game. Over lunch, he explained to me, look, right now, everybody's excited about your ETFs and index funds. But with this kind of passive investing approach, you simply track the market. You cannot avoid market crashes. So as long as things are good, everybody's going to be happy. But when your fund crashes, when the market crashes, your clients are going to be really unhappy. They're going to be upset and they're going to leave you. Intellectually, I knew that this didn't make a lot of sense, but emotionally, he kind of got to me. I would have been tempted to kind of mess with our strategy and maybe reduce the risk a little bit. But fortunately, I could not do that. Our pension fund had to operate according to a strict prospectus, which said you have to stick to your passive ETF and index fund strategy. As it turned out, that was a good thing, because when the market did go down, it turned out that everybody's funds went down. All those competitors didn't manage to avoid the crash any more than we did. And when the market went back up, we did very well. In fact, we became the leader. We had the best performance. And even today, many years after I've left the company, the original fund that I started is always either the number one or the number two in the market going back 10 years. And this is because we managed to avoid a mistake that many amateur investors make, which is changing your strategy based on fear and scary headlines. For long-term success, the best approach is usually to pick a good strategy and stick with it. Now, the next mistake I learned much more recently, in the last few years after Russia invaded Ukraine. As an investment trainer, I taught some Ukrainian investors who live in Western Europe, and they told me that when the war broke out, they had tremendous financial difficulties because most of their money sat in Ukrainian banks and brokerages, and they simply couldn't access it. They couldn't take it out of the country. I've also taught some Russian students who left Russia because they disagreed with the war, and their money got trapped in Russian brokerages because of the Western sanctions. These cases highlighted for me a critical mistake, which is particularly important in today's geopolitical environment with multiple global conflicts happening at the same time. And this mistake is not diversifying your investments and your financial accounts geographically. If all your money is invested in a single market like American stocks, or if all your money sits in a single country's banks or brokerages, that could really hurt you if things go bad. The next mistake is another problem my investing students struggle with all the time. Some of them delay investing for years because of it, and others have actually gotten in trouble with their local government. The mistake is not understanding investment taxes. Yes, taxes can be high in many European countries, but if you learn all the local rules, there are almost always solutions that will reduce your taxes legally and ethically. So high taxes should never stop you from investing, and you should definitely never start investing before you investigate what taxes you will have to pay, because that's an easy way to get into trouble. By the way, if you live in Europe and want to start investing, that is exactly what I teach in my training program, the Index Masterclass. I cover the local tax rules in every European country. I show you how to diversify brokerages internationally and much more. Just follow the first link in the description to find out more. These next lessons come courtesy of my friend Jerome. In 2009, at the worst moment in the financial crisis, when the stock market was down 50%, Jerome had to sell half his stock portfolio. Now, he didn't want to. He knew that stocks would eventually recover, but the problem was he was out of money. He had to pay for rent, he had to take care of his family, so he needed to sell at the worst possible time. He locked in losses that he never recovered. And it's because of two mistakes. One of these mistakes was not having a safety cushion. You should always have some money that's sitting aside, that's not invested, so in case you lose your job or need some emergency cash, you have it available. And the other mistake was having inflexible spending. And this is a big problem with high-income Europeans that I see all the time. While things are good, while you have a big income from your business or a high-paying job, it's easy to sign up for a big mortgage or to rent a house that's really expensive, put your kids in expensive private schools, and so forth. But the problem is you are locking in high, inflexible expenses. And when your income goes down, it is very, very hard to get rid of these expenses. It's very hard to reduce your spending. And that means your safety cushion, if you have it, disappears very quickly and you might be forced to sell your investments. To illustrate the next mistake, which is really, really critical, let me address one of the most popular pieces of investment advice for European investors. Just VWCE and chill. Many YouTube videos and Reddit posts will tell you the same thing. To succeed with investing, simply buy VWCE, the Vanguard FTSE All-World ETF Accumulating. That is all that anybody in Europe needs. It's simple, it's catchy, and it's bad advice. Why is that? Well, where do I start? First, there's taxes. The same ETF can be much better for investors in one country than in another. Second, there's the issue of age and risk tolerance. Sure, if you're 25 years old and you've got decades ahead of you, you can afford to put all of your money into a stock fund like VWCE. Even if the market crashes, you've got plenty of time for it to recover. But if you're 55 and getting closer to retirement, or if you're 70 and retired already, putting everything into a fund like this could be a big mistake. The risk level is simply too high for your age. And third, there's the question of your personal situation and your preferences. An ETF like VWCE invests in global stocks, but in practice that means 60% of your money gets invested in American companies. And today, many European investors are not comfortable with that. With everything that Trump is doing and the conflict between America and Europe and other regions, there's significant geopolitical risk there, and some people prefer to invest more in Europe or generally globally instead of having such a big exposure to Donald Trump's White House. So basically, you might want to customize your portfolio for your personal views and preferences. As another example, many investors want to invest in a socially responsible way. Maybe they don't want to invest in tobacco or weapons stocks. And if you buy a simple global ETF like VWCE, you can't really take that into account. So the key mistake here is thinking that there is just one ETF that is right for everybody. Now, if you'd like to learn how to choose the best ETF for your individual situation and your country, for your individual goals and preferences and age and risk tolerance, plus if you'd like to discover how to best choose a brokerage and handle investment taxes and more, then you might benefit from my step-by-step training program for European investors, the Index Masterclass. Just follow the first link in the description to find out more.